Stein. I'm an assistant professor at Babson College, and I want to thank all of you for joining us today, and also thank in particular Patrick Gregory and all the staff and affiliates of the Cutler Center for organizing this series. The first 2 weeks of discussion have been really interesting for me, and so it's a pleasure to get you to join you in this third week of the Cutler Center's Finance Friday series. Again, my name is Luke Stein. And I'm going to be talking during the next hour about equity market volatility during the COVID-19 era. So the main thing I'm going to aim to do in this presentation is lay out a few facts. I'm going to start by introducing myself, but then before I get into those facts, I'm going to offer a bunch of caveats, and those caveats relate to some things that I'm going to talk about that I don't know. Maybe because I don't know, but maybe because things are moving very fast right now. And so some of the subjects that I'm going to talk about are things that I think probably no one should really stake too strong of a claim on any given day, because things look hugely different day to day. So I'm just going to mention now that I'm hopeful that Zoom is going to hold up okay for us. But if we do have a problem at all, I'm going to try to make a backup stream. So if you need to drop off or if things break down, I'm going to move over to livestream.lukestein.com. So that's just a YouTube page that should mirror this if the feed goes down, and you should be able to find us there. The session is being recorded. I think Patrick remembered to hit the button. He's nodding with a thumbs up, so I think we are recording this. I mentioned that partly because if you need to drop off, you should be able to find this recording later. If you see anything that you're interested in going back to, you can find the recording there, and I'm also happy to distribute the slides. I would also just mention it because we are going to have a Q&A later, and so to the degree that you want to participate in that Q&A, that's wonderful. I'd love to take your questions. I may or may not be able to answer them, but your audio or video recording may show up publicly if you do enter the Q&A. I'll ask folks to just try to keep their microphones on mute during the presentation. If you have something you'd like to say that shouldn't wait for the Q&A, we can probably accommodate that without a problem. If you just type something into the chat in Zoom, which Patrick should be monitoring, so that we know that you're trying to drop in. We do have a lot of people on the call, but we will find a way. Otherwise, Patrick will probably just try to collect any questions that come up through Zoom chat, and you can either type a specific question there, or you can just say, hey, I've got a question, and we'll try to accommodate some or all of those during the Q&A that follows the presentation. So I think that's what I have to say about logistics. And so now, before I get into the meat, let me start with two slides about caveats. The first four are going to be four relatively small ones, and then the next four are going to be really big ones. So my small caveats are that we are in a very fast-moving environment right now. Things are changing very quickly from a public health perspective. Things are changing very quickly from a policy perspective, and things obviously are changing very quickly from a financial markets perspective. And so, as I mentioned earlier, I'm going to try to state some facts. Some of those facts are probably already stale. I may stake a little bit of a claim on trying to interpret or offer explanations, but I think it's really too early for us to have confident views on anything other than maybe what is happening, rather than why things are happening and what's going to happen in the future. All these analyses I'm going to show you are preliminary, and I've tried to include clearly dates on each slide that are sort of as of dates, and some of them are as of yesterday, but some of them are as of a week ago or a few weeks ago. And so I would consider all this stuff preliminary. Like I said, we'll distribute the slides, but if you see something interesting, I'm happy to try to help point you towards an updated version or code that'll let you update these things yourselves if you want stuff that's updated. I'm going to show some analyses that rely on data from various sources, and use a bunch of different measures of things like market returns and market volatility, and I'm going to visualize them different ways. So some things will be on log scales, and some things won't be on log scales. So, please look lively. I've tried to explain what I'm doing, but things may not be exactly what they first appear. And then finally, on the small side, my goal in this presentation is to tell you some of what I'm seeing in the financial markets from a volatility perspective. But this is going to be a presentation focused more on facts than on explanations. So that's kind of 4 small things to keep in mind. Here are 4 more important and bigger things to keep in mind. This is a presentation which is going to be about equity market volatility. The Babson Cutler Center is a finance research center, and I'm a financial economist. So this is going to be a presentation which is about finance. It's going to focus on the U.S. stock market, but there's lots of important and interesting things that are going on outside the United States. There are lots of interesting and important things that are going on even in the United States that are non-economic, and I'm going to come back at the very end of the presentation to just showing a very few facts that are direct public health facts without a particular reference to what's going on in the economy. What's going on in terms of public health is really, I think, more important than what's going on in the economy, and certainly more important than what's going on in financial markets. And so the fact that this is going to be a presentation and a series of presentations focused on the financial markets shouldn't be interpreted as a sign that I or anybody else thinks that those are more important than the human toll that the virus is causing. Most of what I'm going to show you is going to be about large cap stocks, and so I'm going to rely on returns in and volatility of the S&P 500. But of course, the 500 largest public companies in the United States are not necessarily a perfect reflection of what's going on in the stock market, let alone the U.S. or the world economy. And we just have an announcement yesterday evening, I think, unless it was early this morning, that the S&P is not actually going to do their rebalancing this quarter. So even thinking of the S&P 500 as reflecting the 500 largest cap stocks in the market may not turn out to be kind of accurate going forward. So before I move into talking more explicitly about volatility, let me just try to make sure we're all on the same page about where things are at. And again, starting from here, I'm going to be using the S&P 500 as a proxy for the performance of the U.S. equity markets. Despite the imperfections in doing that, I'm mainly not going to use the S&P 500 index for reasons that the students in my Finance 7200 class will be very familiar with. We talked about them on Tuesday, which is the S&P 500 is a price index. It only shows price appreciation. But obviously, a big part of the returns that investors get from holding equities come in the form of dividends. So what I'm showing here, and what I'll try to show on some other slides, is an S&P 500 total return index that captures basically buy and hold returns for an investor who reinvests dividends daily that they receive on an S&P 500 investment, where the key thing that's missing here is the effect of taxes. And this goes back to 2000, what I've shown here. Obviously, we've got the early 2000s dip. We've got a big drop related to the Great Recession, and then more or less steady growth at something. We're on a log scale here, so the line that you might trace through this is kind of relatively smooth and steady exponential growth in the value of a portfolio invested in the S&P 500. And the red cross that I've drawn on the slide moves out to the right and hits yesterday's close. So what you're seeing over here on the very right-hand side is where a buy and hold investment in the S&P 500 would have been as of the close yesterday. When I checked a little while ago, I think we were up about 1.5% in the S&P 500 so far today. So adjust accordingly. And then I've taken that red line horizontally, and the first place where it crosses that portfolio line is back at August 27th, 2018. So one way to think about what that date means is that despite the chaos that we've seen in financial markets in the recent 7 weeks or so, if you are a buy and hold investor in the S&P 500 and you reinvested dividends and you didn't have to pay taxes, so all those other caveats, if you're a buy and hold investor, any dollar that you put into the market before August 27th, 2018 is still up. Okay, so all the volatility that we're talking about in the last 7 weeks has been volatility that has involved an erasure of value in your portfolio only for money that was invested in half of 2018, in 2019, in the early part of 2020. And if we zoom in on what's happened since that August 27th, 2018 date, so we think only about dollars in a buy and hold portfolio that might have gone up or might have gone down, money invested on about 2/3 of those days is down as of the close of yesterday. money invested on about 38% of those days since August 27th, 2018 is up. So this is going to be a presentation that's fundamentally about volatility, but the long-term performance of the market has been strong, and buy and hold investors have actually done pretty well. Now, in about half an hour, I'm going to tell you about some investors who have not been buy and hold investors, for whom recent episodes of market volatility have been devastating. But I do want to think about the long-term trend as we move towards the short term. So here's kind of since that August 2018 date where the market first hit today's levels. So we're just zooming in on the red and green rectangles from the last slide. Yesterday's close is about 17.4% below the S&P 500 peak, which we saw on February 19th. So we're about 17% off from peak yesterday close. Another way to say that is that the February 19th high was about 21% higher than we are today. And if you think about people applying rules about what defines a bull market or a bear market, these are the kinds of drawdown numbers that you might want to have in mind. If we think about a trough, the trough of the current episode was almost exactly 20% below where we are today. So if we just restrict attention to the period in the last 18 or so months during which the market has been above or below the levels that it's at today, we're basically talking about a 40% swing from about 20% below where we're at today to about 20% above where we're at today. And so while the long-term performance of the market does look steady over a sort of a decade long horizon that extends back to just after the global financial crisis, we've now had 18 months during which we've seen plus 20, minus 20, or a 40% swing in market values, and that's a lot. So people are right to feel like markets have been volatile. I think that's the perception all of us watching the markets have had, and that's borne out not only in this kind of more macro time series data, but also in micro data that I'm going to move into talking about more soon. So I'm going to start looking at that more micro data by trying to show a little bit about trends in volatility. And as I did with those simple market return time series, I'm going to start with a longer term perspective, and then I'm going to try to move towards focusing more on what we've seen in just the last 7 or 8 weeks. So what this graph does, and I'm hiding 3 years that of course I'm going to show you in a minute, is this graph traces out histograms of daily returns on the S&P 500 for every year going back through 2001 through this year so far. Now, of course, we sometimes see extreme market movements, and in order to keep everything on a nice, simple horizontal x-axis, what I've done is I've just truncated every return which is bigger than plus or minus 3%, which is a standard measure that sometimes gets used by financial analysts of thinking about large moves in the market. Some other folks use 2.5% for other purposes. I drew this graph using 3%. And so any move which is larger than a plus or minus 3%, you're going to see in red. And of course, what you'll note is going back to 2001, we sort of see a few each year. 2002, we see a few each year. 2003, we see one on the downside. We see a few on the upside. 2004, 5, 6, we go 3 years or about 750 trading days without a single return larger than plus or minus 3% in the aggregate S&P 500. 2007, we're back at a few. Then, of course, I'm covering up the global financial crisis for now. 2012, 13, 14, we have another 3-year stretch during which we never see a plus or minus 3% move in the markets. 2017, we see no 3% moves in the markets. So coming off of a decade or 2 decades during which most years have actually been very, very low volatility from a historical perspective, we of course have a few episodes where volatility was very heightened. So 2008, 2009, this is the global financial crisis era, and you can see a whole lot of red here, where the degree to which you're seeing red bars, that is to say changes plus or minus 3% or greater, in some sense understates the degree of volatility, because a whole lot of those 3% plus or minus changes were not threes, they were fours or fives or sixes or sevens or eights. And we're going to see that on an upcoming slide. So here's where we're at for 2020 so far. And what I would just highlight is, of course, the y-axis scale for 2020 is very low. Well, why? Because we're only a quarter of the way through the year. This is as of April 6th. But as of April 6th, we've already seen more days with very large stock market movements. And critically, despite the fact that it's felt like we're in a crash, we've seen very large movements down as well as very large movements up. And we've seen more of those movements in 2020 than we did combining 2019, 2018, 2017, 2016, 2015, 2014, 2013, 2012. Okay, so the degree of heightened volatility in the markets, just looking at this simple measure of the degree of large stock market movements, has already been massive this year. So what are we seeing? We're seeing volatility that comes from uncertainty. And I would think of this as uncertainty over three distinct sources, which of course is not an entirely overlapping way of characterizing them, but at least for me has been a useful framework. And that is uncertainty over the extent of the virus. We've continued to learn more and more information about the degree to which COVID-19 is actually affecting patients in various parts of the world, how many cases there are, how many are symptomatic versus asymptomatic. So just the simple extent of the virus, and I think of that as being a public health fact that we don't really know much about, and we're learning more and more. The second source of uncertainty in financial markets has been uncertainty about the effects of the virus. And of course, those effects have been relatively more direct ones. There's going to be a continuity of directness versus indirectness, but there have been direct effects on workers who aren't able to show up for work, or folks who are unable to buy consumer items. Of course, there's also a number of indirect effects, including effects on financial markets. So not only have firms been affected and the value of those firms have been affected, but financial intermediaries, investment funds, hedge funds, other types of investors have been affected more directly by the virus. And so those have also affected financial markets, not only through what we might think of as sort of simple cash flow channels, but also in terms of what supply and demand is for financial assets of various kinds. And then, of course, there's also been response to the virus. And a lot of this has been on the policy side. Jerome Teilhard gave a great presentation 2 weeks ago, laying out what had started to be policy responses on the monetary side, on the fiscal side around the world. Most of those have characterized short-term policy responses and an attempt to do things that we sometimes characterize as flattening the curve, or trying to put the economy into a medically induced coma, other kinds of analogies that are getting used. But of course, the policy responses are also likely to have long-term effects to the degree that the structure and level of government debt are going to be different, the structure and size of the Federal Reserve's balance sheet is going to be different, and tax policy may need to adjust over the long term in order to pay for the short-term policy response, and those long-term adjustments to the tax system are likely to have implications for the economy. So here's kind of what a more zoomed in view looks like of the slide I showed you before during the global financial crisis. So here's 12 months around the GFC, so late 2008 through the first half of 2009, and you can see that we've basically got what, depending exactly how you count, were kind of 6 or 7 months of very heightened volatility in equity market returns using this plus or minus 3% return measure, starting in September 2008. And when I move to showing you a view that's like that but zooms in on the last 12 months, of course, I'm not able to put the coronavirus epidemic in the middle of this chart like I did with the global financial crisis, because we don't know what's coming. We don't know if we're in the middle of it now. We don't know if we're still at the beginning. But whereas the global financial crisis, you might say, roiled equity market returns, at least using this very naive measure, for something like 6 or 7 months, we are basically now 2 months into this period of heightened realized S&P return volatility with coronavirus. So we see the first very large negative returns show up in mid-February, and we've continued to see heightened volatility in the markets even through today, although whether we've bent the curve on that remains to be seen. So we're basically talking at this point about 2 months of heightened volatility, whereas I'm going to show you in a minute, the volatility we've seen for the last 2 months is, not incomparable to the levels of volatility that we saw at the peak of the Great Recession, according to some measures. That just went on for about 7 months. Do we have a 7-month period of volatility here? Some might say we've got 2 months. Some might say we've got 2 years. So we're going to see. So here's another visualization of the same set of facts that I just showed you on the last 2 slides, but one that's designed to try to highlight not just changes in equity market returns or levels of equity market returns above plus or minus 3%, but how big those returns were. So let me tell you what we're seeing on this graph. On the horizontal, we've got a time series, and this one is running from April 2008 through June 2009. Think about the peak of the global financial crisis. On the vertical axis, we've got daily S&P 500 returns. So the same kind of numbers that we're feeding into the histograms or distribution plots that I showed you on the last 2 slides. But what I'm doing here is allowing the scale to go all the way out. So rather than truncating at plus or minus 3%, which are the red horizontal lines, I'm letting this thing go out as far as it did. And the numbers that you see on the graph are just the calendar dates. So if you look, for example, here where my mouse is pointing, this is October 15th, 2008, and that's the lowest down number that you see. And indeed, October 15th, 2008 was the most negative return that we saw, just shy of negative 10% on the S&P 500. The most positive return that we saw in the S&P 500 during this era happened just 2 days earlier on October 13th. And was a swing of more than plus 10%. Okay, so this is what the financial crisis era looked like. And I can't point at the slides as I might if I were at a whiteboard. But you'll notice that until more or less the green box that I've drawn on the slide, basically all daily returns were within those plus or minus 3 percentage point red bounds. We see an explosion or a widening of where those dots show up, with not only very large positive, but also very large negative returns. Although in the early part of the global financial crisis, the large negative returns outnumber and dominate in magnitude the large positive returns, although we do have 2 very good days in October. And then things slightly taper off from a volatility perspective as the scatterplot narrows. And when we reach mid-April 2009, we've more or less reverted to a world where most of our daily returns are within those red plus or minus 3 percentage point bounds. So here's the equivalent graph. And if I've done this right, the scale should be almost exactly the same. Again, I can't put coronavirus in the middle because I don't know what's going to happen, but I have given us a year looking backwards. And one thing that actually may or may not be obvious from looking at the graph is that if you look at what we've seen over the last 12 months, excluding the last 8 weeks, okay, that is to say, if you look from, today is April 10th, if you look from April 2019 until mid-February 2020, not only are almost all of the returns within those red plus or minus 3% bounds, but in fact, most of them are tightly within those red bounds. They're clustered relatively close to zero. So I'm going to go back a slide and point out that during the pre-global financial crisis months, we actually were seeing more dispersion in returns than we were seeing in the pre-coronavirus era. And we're going to see some time series evidence later in my presentation consistent with that. But one of the things one of the things that we're going to see is that not only has this been a heightened volatility episode, at least over the last 8 weeks, but it's coming off of a very low baseline, a period during which markets were, in fact, fairly steady, and volatility traders were relatively sanguine about the forward-looking degree of volatility that they expected. Abdul, I see your question in the chat. Thanks for that. It's very well timed. Abdul asked in the chat how volatility looked with respect to the Great Depression. So this is a visualization which is not mine. It's from Scott Baker at Kellogg and Nick Bloom, who's at Stanford and actually was my PhD dissertation advisor there, along with some other co-authors who are also great but are just later in alphabetical order. And what Baker, Bloom, Davis et al. Have done in some of their work, including this, is they've tried to develop very long time series of equity market realized volatilities. And the one that they're doing here is they're showing every 2 weeks how much volatility was there. They're using a different measure here, which is the sum of the squared returns over the last 10 trading days. And so each bar here is a 2-week period. And so if you look at the great crash of 1929, you can see that the sum of squared returns over 10 days was approaching 6%. As of when they updated this graph, which was March 23rd, they were at about 5% for the coronavirus pandemic. So the actual peak that we've seen in this measure came as of Black Monday in 1987. But of course, the height of each spike is just showing us 2 weeks realized volatility or 10 trading days. And that Black Monday spike is very, very narrow. So it's not that there was no hangover, but you can see things revert relatively quickly to something closer to baseline levels, whereas the Great Crash is followed after a dip by a very, very long period of heightened volatility, according to this measure, that persists for almost a decade at heightened levels after the Great Depression. The global financial crisis also has a little bit of this hangover effect. It, of course, remains what's to be seen over not only coming months, but coming years. So one more different visualization, and I hope that folks will pardon me for throwing lots of different things at you, but this is some of the exploratory work that I've been doing as I just try to see what's interesting to me and what's going on. So these are slightly confusing scatter plots to read. Let me just focus up here on 2001 and try to tell you what's happening here, since all the other scatter plots look the same. Every dot on this scatter plot is one trading day during the calendar year 2001. And on the horizontal axis, that's the x-axis left-right, what you're seeing is the overnight return. So the return on the S&P 500 from when markets close on one day to when markets open on the subsequent day. And then on the y-axis, on the vertical axis, what we're seeing is what the return was during the following trading day. So you can think about each dot on this plot as representing a 24-hour period, although I need to put an asterisk on that 24 hours there that I'll explain in a moment. But you can think of this as representing a 24-hour period from when the markets close one day to when the markets close the next day. And the horizontal asks how much of the return during that period was the overnight piece, and the vertical asks what was the return during the daily piece. So if you look at 2001, we've got one very, very extreme outlier here, which is in the upper left-hand corner, but mainly is way out to the left. So that means a very, very large overnight return, which was negative and then turned out actually to be followed by a relatively large positive return during the following day. So this is not really an audience participation type of chat, but since there's some people in the chat, would anyone like to suggest in the Zoom chat what day they think this was here, which is our extreme outlier in the upper left-hand corner? So we have a couple suggestions of 9/11, September 11th. Matthew has just jumped in and said September 12th. So he's thinking, I think, about the same episode, but noting that the returns in question our daily returns that would be occurring on the day after, it turns out actually financial markets in New York were closed for several days after the September 11th attacks. And that was my asterisk on saying from the close of market one day to the close of market the next day, or 24 hours. In fact, that date is September 17th because financial markets were closed September 12th, 13th, 14th, 15th, and 16th. So the overnight change that we're seeing there on the horizontal axis in 2001 is actually an overnight change that happened over the course of 6+ days. So I'm going to take those labels away for a moment and then we'll put them back. So if you look at these scatter plots, you can see the shape of them changes over time. But to the degree that a scatter plot is sort of spread out horizontally, what that tells you is a lot of the financial news that was arriving and affecting market returns was news that was arriving overnight. To the degree that one of these clouds is spread out vertically up and down, that's telling you that a lot of the financial news that moved markets is news that was arriving during the day. And financial scholars and researchers have done a lot of thinking that I'm not going to be able to summarize in this call about what kinds of news arrives overnight versus what kinds of news arrives during the day. You can see that, for example, 2008, the size of this cloud has really, really blown up in both directions, certainly relative to very calm years like 2004, 2005, where we see basically no large moves either overnight or intraday. So I'm going to move us forward down here to 2020, and you'll note that 2020 has a very unique and very different shape than the clouds we see on any of the other slides, where there's massive horizontal dispersion. And relative to the amount of horizontal dispersion, actually not so much vertical dispersion as, for example, there was in 2008. So having shown you before that 2008's peak and 2020 have what are arguably similar levels of volatility, at least the months we've seen so far in 2020, there's actually a big difference in the character of that market-moving news that's arrived, which is a whole lot more of what we've seen in 2020 that's moved markets large amounts has been news that has arrived in the overnight markets. And so, for example, overnight March 16th, we saw the market move down more than 10% overnight. March 13th, March 24th, we've seen very large positive market movements in the overnight markets. So what's going on there? I don't have a precise explanation, but I have a speculation, which is that more of the news that has been moving markets so far this calendar year seems to be news related to policy announcements that get made outside of market hours, or public health news, much of which has arrived from overseas during periods of time that the U.S. financial markets are closed. There's probably other stories, but those are at least two. Scott Baugus, who is a research economist until recently at the SEC, has put together an interesting analysis, interesting to me, which builds on a very classic piece of financial research that was quoted in the New York Times on the left-hand side, noting that the stock market works by day and loves the night. And this is because historically, it turns out the pattern has been that stock markets' broad upward movement has tended to occur in the overnight markets, and basically during intraday, during the market opens, or intraday movements have on average been fairly close to zero. What Scott Baugus has documented is that, in fact, in the last few months, that pattern has exactly reversed. So this is Scott's graph on the right-hand side. He doesn't have a paper, but this is from his LinkedIn page and used with permission. And what he's shown in black is basically what would be the returns on a buy and hold portfolio, which only operated from the close of the market until 5 minutes after the open. So a little bit different from what I showed you on the previous slide. And then in the dashed line, what the return would be on a portfolio which only held stocks from 5 minutes after the open until the close of business. And if you trace out the dashed line, you'll see as of when he last updated this analysis, you're up about 5% on your daytime trading portfolio relative to mid-February. But if you trade out if you trace out the solid line, you're actually down about 33% on your overnight portfolio, and the red is just showing the difference between those two, the night minus day returns. So to go back a slide, that's basically a fancy way of saying, slightly different because he's using the first 5 minutes as part of overnight, because he's only including back to mid-February, and my scatter plot shows the full year. But roughly speaking, what Scott's graph is showing you is that if you took my 2020 scatter plot down here and you think about weighing up all of the dots, there's more weight on the left than on the right. So overnight returns have been negative much more than they've been positive. But if you weigh this thing top to bottom, it's actually relatively evenly balanced at zero. Intraday returns have actually been sort of, on average, neither large nor small, and pretty close to zero. Okay, so that's kind of the end of the first set of facts that I want to tell you about, all of which are backward-looking facts about realized volatility, about what has already happened in the market. And the transition that I want to make now is to start telling you some forward-looking facts, some facts about what might happen in the markets going forward. And these are not going to be my forecasts or predictions. These are going to be my characterization of market participants' forecasts of volatility, in particular, a measure of so-called implied volatility called the VIX index. And so what is that? Well, it is the level of forward-looking volatility. So how much volatility do investors expect in the market over the next 30 days, as implied by the price of equity options. Now, I'm going to not be able to offer as much of an explainer as I would like about what the VIX is and why the VIX might forecast forward-looking volatility, but I'm going to give a very, very quick summary, which is based on a piece that I wrote, which is posted on my LinkedIn page and on Twitter, called Not Nearly Everything You Wanted to Know About the VIX and Other Volatility Indices. And the idea of the VIX, and that I tried to summarize in this article, is that basically if we want to understand what the market's forecast is of something, and in this case, we're going to try to forecast volatility in financial markets. If we want to understand the market's forecast of something, one way we can do that is we can try to find some asset whose price today is related to what X is going to be in the future. And so to the degree that market participants forecast that X will be high in the future, they should be willing to bid up the price of that asset X today. To the degree that they expect that X is going to be low in the future, they should bid down the price of that asset today. And so given that prices are determined by the supply and demand of that financial asset, we should be able to use the price of a financial asset to understand something about what the market's forecast of X is. This is the classic thing that we do when we basically reverse something like a DCF, a discounted cash flow model. We assume that the price of a stock is based on the market's forecast of, let's say, what future dividends paid by that company are likely to be. And therefore, we can infer something about the market's predictions of future dividends from the price at which the stock is trading. There are some very important cautions that I'm not going to have time to get into here, but relate to the fact that the supply and demand of an asset may be determined by things other than market participants' forecast of X. And in this context, that's going to suggest that the VIX index may, in fact, be driven in important parts by things other than market participants' volatility forecasts. But I'm going to sweep those concerns aside for the next 20 minutes, even though they're extremely important. Well, it turns out that the price of equity options, these are derivatives contracts, which are related to the degree to which the future price of a share or an index is above or below a given threshold, that the price of options increases with volatility. Call options become more valuable when the market expects a higher probability of increasing share prices. Put options become more valuable when the market assesses a higher probability of negative returns. And that's not just about the probability of returns, it's also about the magnitude of those returns. And so given that that's true all else equal, and prices shouldn't be too predictable, we can use options on the S&P 500. And in particular, what the CBOE, or Chicago Board of Options Exchange, does is they use options on the S&P 500 index with expirations, of 23 to 37 days in order to come up with an index that can serve as a proxy of market participants' expected volatility of the S&P 500 over a 30-day forward-looking horizon. So whereas everything I've shown you so far has been backward-looking, we can arguably use today's VIX to say something about what market participants expect the next 30 days to look like, and we can also use VIXs in the past to say something about what past market participants expected they might see in the future. We can then, of course, evaluate those predictions with the benefit of hindsight. So it turns out that in general, the VIX does a reasonably good job, reasonably good with all those caveats that I mentioned before about supply and demand. The VIX does a reasonably good job of forecasting something about equity market volatility. So what this scatter plot shows is every dot is a trading day during the last year. On the horizontal axis, the graph shows what was the VIX at the end of the day yesterday. And then the vertical axis shows what happened to the S&P 500 today. So we're trying to assess something about the VIX's ability to predict market returns. We're going to use the previous day's VIX and try to say something about what happens to the next day's S&P 500 returns. And this scatter plot basically traces out kind of a funnel. You can think about a V shape that starts at the left and expands out to the right. When the VIX is low, the next day's market returns tend to be relatively small. When the VIX is high, the next day's returns tend to be relatively large. So this is consistent with the idea that the VIX maybe has something to say about what's going to happen over the next day, if not the next 30 days. This graph is trying to trace out something about the performance of the VIX, which is shown here in orange. I call it implied volatility here, and compare it with subsequent realized or actual volatility in blue. And you can see the things trace each other relatively well. Now, in fact, understanding and explaining the gaps between the orange and the blue lines is extremely important, a very active area of academic and practitioner financial research, and attempting to predict and exploit the gaps between the blue and the orange line result in trading strategies that have made investors tens of billions, if not hundreds of billions of dollars, but have also lost a lot of money in the last month. More on that to come. The VIX index is a 30-day index, so tells us what financial market participants expect volatility might be over the next 30 days. But CBOE also publishes analogous indices using longer-term options. And so what this graph, which is just straight from CBOE but summarized by a website which is very useful called VIXCentral.com, is it shows us what the CBOE's VIX implied volatility is for every calendar month going out through the end of the year. And these volatility units on the y-axis are showing annualized standard deviations. So with all the caveats about the orange and the blue line not matching up on the previous slide, about the price of the options being determined by supply and demand that may be affected by other factors, the most naive interpretation of this might be that that VIX investors are estimating that the standard deviation of stock market returns before the option expiration date in April is consistent with stock returns having a 44% annualized standard deviation. So those are returns over the next month, but written in terms of volatility over the next year. That 44% standard deviation compares with historical S&P 500 realized volatility, depending what horizon you want to go back, but of, let's say, something like 16 to 24% per year. So the markets seem to be forecasting that April volatility will be at something like 2 to 3 times historical average levels. But the markets are forecasting that at longer and longer horizons, those levels of volatility are lower and lower. So some market evidence consistent with an assessment that things may normalize, although this December number remains very high relative to long-term historical averages, and in particular, very, very high relative to the very low levels of realized volatility that we were seeing over the last 2 decades, excluding the global financial crisis and the last few months. So what I'm showing on this graph is basically overlaying the S&P 500 in blue. And so this is like the first slide I showed you, although now I'm actually just using the actual S&P 500 rather than that total return index, and only because folks are familiar with those numbers. And then in orange, I'm showing the VIX index on the right-hand side. So if you just focus on the orange, the VIX only goes back to 1990. So we have a much shorter time series than that Baker, Bloom, Davis et al. Evidence that I showed earlier that went back to before the Great Depression. But you do get a sense that the high-frequency VIX peak that we saw in March, I want to say that was March 16th, was the VIX peak that we saw, peaked at a level lower, but not much lower than we saw at the very, very height of the Great Depression. Now, one other thing that you may notice looking at this slide, and this is actually going to be a point that's going to be the focus of the next section of my presentation, is that if you kind of run a squint test regression on this, it sort of looks like when the orange line or the VIX is high, the market sometimes seems to be going down, like during the Great Recession, during this early, hopefully not just early, but this early part of the coronavirus era. So when the VIX is high, when the orange line is high, the market tends to go down. When the VIX is low, the market seems to tend to go up. And it does turn out that that the VIX and the market tend to move in opposite directions. So that's what I'm going to focus the next part of my presentation on. And I'm going to characterize that as the ability to use volatility as a hedge. So what's a hedge? Well, a hedge is an investment that moves in the opposite direction from the remainder of your portfolio. And so to the degree that volatility tends to be high when markets are going down, or volatility tends to be low or falling when markets are going up, an investment in volatility can serve as protection on an investment in the broader market. Okay, so that was what we saw trying to pass a squint test. And it turns out that if we focus on the month that characterized kind of the middle month of the coronavirus epidemic so far, and I've chosen these particular dates for a reason, that ability of volatility to hedge market returns was very, very strong. Okay, so what are we seeing on this scatter plot? On the horizontal axis, we have the value of the S&P 500 index, and on the vertical axis, we have the level of the VIX. Every dot is a day, and those days are labeled with the calendar date. So although it's a little bit hard to see, the 19 behind the 20, all the way over there in the lower right-hand corner of the graph, we have February 19th, 2020. That's the rightmost point because the S&P 500 hit its all-time, so far, high close, just short of 3,400. So as we look forward over the month that started on February 19th and ends March 16th, we've got a little bit of a wiggle in the middle, but basically we're moving up and to the left. And what does it mean that we're moving up and to the left? Well, it means that the S&P 500 is falling. So the market is falling. That's our movement to the left. And the VIX is rising. This market option implied volatility measure is going up. So on March 16th, VIX hits its all-time high close. So what happens? Well, this thing actually has a really, really linear look to it. As the S&P falls, the VIX goes up. And in fact, the relationship between those two is more or less linear. Now, it turns out that the VIX and the S&P 500 tend to move in opposite directions. So markets tend to fall when they're uncertain and tend to rise when they're becoming more certain. And so we can think about movements on that scatter plot I showed you on the last slide as basically representing the arrival of market moving news across two dimensions. A dimension associated with market returns, where when we move to the left, we're getting news about financial markets, which is bad, relative to expectations. When we move to the right, we're getting news which is good relative to expectations. And then in the vertical axis, the VIX serving as a proxy for the degree to which market participants are uncertain about what's going to happen over the next 30 days. And as we move up, the news that's arriving is uncertain news. It's news which raises questions about what's going to happen in financial markets. As we move down, we're seeing news arrive, which is basically resolving news. So what characterizes that mid-month of the coronavirus era? Well, it appears to be news which is, by and large, uncertain. So we're learning that we don't know what's going to happen in the future, and bad. But what we do learn doesn't look very good. Okay? So, well, how often is uncertain news bad, and how often is bad news uncertain? It turns out that uncertain news tends to be bad, and bad news tends to be uncertain. If we think about the R-squared of a regression like that monthly regression I showed you here, so if we think about just running a regression through all of those daily dots for a month that ends March 16th, 2020, it turns out that we usually see an R-squared consistent with a linear relationship there. But the R-squared that we saw for that 30-day period I just showed you, the month ending March 16th, 2020, was the highest R-squared that we have ever seen during a similar regression. Okay, so the sort of modal R-squared for a regression like that, to what degree is good news certain news and bad news uncertain news, is kind of a 0.85 R-squared, but there's lots of times that we see R-squareds that are much lower, or perhaps even very close to zero. The month ending March 16th was the episode where the relationship between good versus bad news proxied by S&P 500 market movements and certain versus uncertain news proxied by VIX changes was in fact the highest degree of linearity that we had ever seen. Okay, so if I take that scatter plot, but I bring it back a decade, you can see sort of where this coronavirus episode in the last month is shown in orange relates to sort of a decade's worth of trends in this space. And of course, the overall flow of this graph is from the left to the right, because over the course of a decade, economic growth is driving the S&P 500 up. So we've seen these kinds of bad but uncertain news followed by good but uncertainty resolving news. We saw it. We don't see the global financial crisis on this graph because I'm only going back a decade, but we saw it May through December of 2011. We saw it August, September of 2015. We saw it in February of 2018, and then again in December 2018. And then we've seen a very, very large move in that direction from February through mid-March of 2020. I say mid-March advisedly because that 2016 date takes us all the way into the upper left-hand corner relative to the current episode. If we compare that with a graph that goes back further, so now I'm showing 15 years rather than 10 years, you can see how our current episode, which of course has only gone on so far for something like 2 months, compares with the 10 months centered around the Great Recession. And one thing that you might see if you squint is this Great Recession era was characterized by not just one, but actually two separate, very, very large VIX spikes, and then several more large but not quite as large VIX spikes. So it's not always the case that we do a simple up to the left, down to the right. Now, there's another thing that this graph helps highlight, which is that using this visualization, something seems to have happened. So we were on that very, very stark R-squared of almost 1. Good news is resolving. Bad news is uncertain. March 17th, things look to change. So March 17th, 18th, 19th, 20th, 21, 22, 23, we see what looks like bad news, but bad news associated with the resolution of uncertainty. So the VIX is falling at the same time that the market is dropping. Now, if you look at this long 15-year time series, you can see some other episodes where it looks like some of that stuff happened during the Great Recession, where it happened. But it turns out that, in fact, what we saw from March 17th through the end of March was, in magnitude, an extremely unusual episode. So I realize I'm throwing a million visualizations at you, but here's one more. I think if I look at my slides, this is going to be the last new visualization I show you. And what this visualization does is it basically takes every one of the little lines on this graph, and in fact, every single one, not just 15 years, but going back to 1990 and the creation of the VIX, it takes every little line and asks what direction was that day's movement relative to 0, 0. So on the horizontal axis, we have not the S&P 500 level like we did before, but the S&P 500 return. And on the vertical axis, we have not what's the VIX's level, but what's the change in the VIX since the previous day. And the fact that we tend to move up and to the left or down and to the right shows up as a very strong negative regression result over 30 years of data, 1990 through today. Typically, when the markets go down, the VIX goes up. When the market goes up, the VIX goes down. But sometimes it does more than expected. And what I've highlighted in red are the 15 weirdest VIX declines. Okay, so this is 30 years of data. And in red, I highlight the 15 days where the VIX has dropped the most relative to what we would expect given the movement in the market. And of those 15 largest weird, I'm not going to say unexpected, but weird VIX declines, 6 of those 15 have happened in the last 4 weeks. And the largest unexpected VIX decline, or sorry, the largest weird VIX decline ever happened on March 20th, 2020. Okay, so if I zoom in on the scatter plot, you can see March 2020 is a day where the VIX dropped a whole lot, while markets also dropped a whole lot. So what does that mean? Well, it means from a news perspective that we got news that resolved uncertainty, but it resolved it in a bad direction. It also means from an investor's perspective, if you had bought volatility as a way to try to hedge your market exposure, you got absolutely killed on March 20th because the market fell and your hedge position, your volatility position, also fell. So this is one, but not the only reason that volatility investors have had a very, very strange and for many of them uncomfortable month over the last few. Okay, so I'm going to take just a few minutes now that we're at 10 o'clock to try to say a few things about where we might go from here. And then we're going to have a question and answer for anyone who's interested in and able to stay on the discussion from there. So, I think that trying to say more about what's going to happen in the equity markets, as I noted at the outset of the presentation, is going to involve learning more about what the public health reality of COVID-19 is, but also what the economic implications, both directly of the disease and the outbreak are, but also of the response, much of which is a policy response. So right now, we are still learning more about what the cash flow impacts are for firms in different industries. So I'm not going to go through these, but I'm just going to point to some particular sources from new academic research that maybe speak to some of these questions. The first is a paper from Scott Baker and co-authors. I mentioned Scott's work earlier, going back to the Great Depression, which tries to look at the degree of consumer spending declines in various industries, and this is using credit card data from a panel. We've seen massive declines after a very sharp uptake as early news of the pandemic was arriving. How long are those declines going to last and how big are they going to be? I think the market is still sorting that out. The second thing I would show you is some evidence from Tariq Hassan and co-authors, where they've looked at the degree to which earnings conference calls in different countries mentioned COVID-19, SARS, H1N1, Ebola, Zika, and MERS. And the key thing that I would take away from this graph, although you're welcome to look at the underlying paper or just at the slide later for more details, is that we're already seeing that COVID-19 is at least getting mentioned by financial managers at a much higher rate than earlier disease spreads or pandemics were in basically any country, with the exception of the discussion of SARS in China at the peak of the SARS era. So it seems like people think this is important, but we're still trying to figure out what's going on. I would point you towards some evidence from Gormson and Koijen at Chicago booth. And this is new work which tries to understand not market volatility forecasts, which are what I was showing you before from the VIX, but rather using dividend strips and other kinds of financial market assets, forecasts of dividend growth and forecasts of GDP growth in the US and overseas. And it looks like right now, the dividend strip markets are forecasting 25 to 30% declines in next year's dividends, and 2 to 2.5% decline in U.S. And European GDPs next year. And then if you look at a lower bound on those forecasts over longer horizons, the lower bound, and therefore you're seeing bigger declines here than you saw in the expectation forecast on the left-hand panel, but declines, the S&P 500 is in red, of at a lower bound perhaps as large as almost 40% 2 years from now, with a recovery, but a recovery that's potentially over a very long time horizon. So ultimately, what is it we need to figure out? Well, the driver of all of this is really likely to be uncertainty over the spread of the pandemic. So, of course, we don't know what the effect of the pandemic is on places where it strikes more rather than less. But at this point, I think a whole lot of the financial market uncertainty, but also uncertainty of other kinds, relates to the degree to which we just do not know about the degree to which infection, hospitalization, and death rates are likely to change. And so, having already gone a little bit over my promised time, I just want to take a minute to highlight a public health rather than a financial market fact. And so what this graph does is it traces out daily deaths in blue versus cumulative deaths in orange from COVID-19 in the United States. This is from the Johns Hopkins CSSE data. And as of yesterday, they were estimating 16,500 cumulative deaths in the U.S., which was up 1,783 from Wednesday. Okay, so this is a big deal, and it's already a big deal. But I think a lot of the uncertainty in the financial markets relate to the fact that we just don't know what is going to happen with this disease, and those are questions for epidemiologists, not for financial economists. But one place that you can see perhaps some room for hope, again, not from an epidemiologist, but just from somebody who likes to look at data and likes to think about visualizations, is that because I've plotted the orange line and the blue line here on the same graph, and on the same log scale, you can think about the distance between the blue line and the orange line. The distance between the blue line and the orange line tells you about the growth rate of deaths in the United States. Okay, so that's comparing daily deaths to cumulative deaths so far. And so as we've proceeded from mid-March, and remember March 16th was that day where we saw the highest level of equity market volatility as proxied by the VIX. As we've traced out from March 16th, there's been a hopeful level of divergence between these two lines. You can also see that that the orange line is starting to bend down, and this is that bending the curve that we've heard so much about. So questions about the resilience of individual firms or sectors, questions about the policy response to COVID-19, I think are likely important to understanding what's going on in the financial markets. But my guess, and this is by far the most speculative that I'm going to get in this presentation, my guess is that a lot of what's going on is that financial market participants just do not know and are trying to forecast how big and how bad they think this is going to be. So I'll kind of end with the famous Financial Times graph. And I liked this visualization from Frank Donnarumma. It's not really a visualization. It's really just a piece of graphic design where he took the FT graph, the famous FT graph, and has just overlaid it on the well-known Hokusai Ukiyo woodcut drawing of waves crashing over Mount Fuji. And there's a lot of waves in that drawing, and nobody knows where they're going to come down. We only know and hope that they are going to come down. Where the waves crash and how fast they bend, that's the thing that we all want to know. We should want to know from a public health perspective, but it does also have implications for the markets. And for those of us who are most comfortable with and familiar with looking at financial markets data rather than epidemiological data, it's a place to try to see evidence of what we're learning and when about what's going on. So I'm going to end there. I'm going to move to Q&A. If you can't stay or you don't want to stay, but you have anything you'd like to talk with me about, please shoot me an email. I'm also covering a lot of these topics on an ongoing basis in good conversation with lots of folks, many smarter than I am, on Twitter, where my account is Luke Stein. So you're welcome to follow along there. So I will end there, and I'm going to pass it to Patrick in case you want to do any moderation.
Thank you very much, Luke. That was very informative. We did get a couple of questions that came in. One is from Jerome, who asks, is your characterization of the data based on dividend strips that the market has baked in the significant drop in GDP and earnings for next year?
So thank you, Jerome, for a great question. So the evidence that Jerome is asking about, I think, is kind of this Gormson and Koijin. So I guess my read on their paper, which is early work by them, meaning it's early and it's not my work, so I want to be very careful how I characterize it, is that they are looking at dividend strips to try to understand dividend growth forecasts, and they are looking at GDP forecasts, but I do not remember that their paper tries to then combine those dividend strip forecasts with an equity valuation model to try to say something about whether the evidence across those two is consistent with each other. So that's basically to say, I don't know. I don't think that they know, or at least that they know in that paper. But I think it's a really good and interesting and important question.
Thank you. One last question is from Scott, who asks, do you suggest holding volatility in the portfolio as a hedge all of the time, or only when it increases? Thank
you, Scott, for a great question. So Scott's question is about whether I suggest holding volatility as a hedge and when. So I'm gonna say I don't make investment recommendations because I'm a little bit more of an efficient markets absolutist then allows me to feel comfortable with offering suggestions. The main thing I would say is I do not suggest holding volatility as a hedge in your, and I'm flipping back in slides in order to try to get to it. So I don't suggest holding volatility as a hedge for anyone who is not absolutely expert at managing a volatility portfolio. And I am not an expert at that. Ben Eifert, whose tweets I've screenshotted here. So Ben is an expert in that, and sort of likes to cite Simpsons cartoons on days when it turns out that the money is all gone. It turns out that many of the relatively vanilla instruments that one might think to hold as ways of investing in volatility are instruments that either move very, very quickly in response to volatility changes, or that can move very quickly for reasons other than the expected shifts in short-term volatility. And so this is an extremely easy way to get wiped out. So I'm not actually answering your question about whether volatility. I take your question more, Scott, as a question about whether volatility is a more effective hedge when volatility is high versus when volatility is low. And that's a great question to which I don't know the answer. But I am not going to suggest to anybody holding volatility as a hedge unless they know more about what they're doing than I do.
Great. We did have one last question that just came in from George. I wonder, George, would you mind asking the question?
Sure. Yeah, I can expand on it. My question has to do with, are you able to know what percentage of value in the S&P 500, those 500 firms, come from expected earnings growth over the next 12 months versus the total lifetime of future cash flows?
So thanks, George. So that's a fantastic question. The answer to which is very subtle. So George's question, as stated in the chat, and then with a great expansion by voice, was about what percentage of S&P value comes from earnings growth in the next 12 months or 4 quarters. So I would sort of sharpen things a little bit by saying that in a dividend discount model world, the value of an equity investment comes from dividend payments rather than from earnings. And so maybe the reason that we care about earnings in valuing equities is because we think that earnings contribute indirectly to the firm's ability to pay dividends. So there is a very active area of financial research which seeks to understand the duration of equities so that is to say, asking how much of the value of equities is coming from shorter term versus longer term dividends. But George, your question is stated, which is about how much is coming from short versus long term earnings, is also going to require knowing a whole lot about dividend payout policy and the relationship between earnings and free cash flow, which is not just about dividends, but payout, but also relates to investment in operating capital. And so that's a long way of saying I don't know the answer to an interesting question. I think that your interesting question actually has at least 2 really hard pieces to answer, and I know that there are people, including maybe some people on this call, who know a lot about the duration piece, but that's going to be more focused on dividend duration. How much is coming from earnings? I don't know.
Thank you, Luke. I think that is all the questions that we've received.
Okay, well, in that case, I am going to say just a final thank you to Patrick, and then also to Farah and all the staff at the Cutler Center for organizing this. I am looking forward to continuing conversation on these topics, so please drop me a line if that's something you're interested in doing.